Okay, this video is to help customers that have purchased or thinking of purchasing one of the Mountain Trading Solutions trading robots. Okay, the reason I'm doing this is because a few customers have mentioned that the actual net profit wasn't very high, and there's a reason behind this because the actual test results, the test results are realistic. Okay, we're not looking at the average person will probably put £1,000 into their account. Okay, but at the same time they don't want to risk 50% of that £1,000 just to gain 20%. I mean, that's crazy. So the vendor who created this product has actually managed to get the drawdown very low. So the drawdown, just quickly briefly explain drawdown, why it's important. On this chart here you can see that it says max balance drawdown and max equity drawdown. Now the max balance drawdown was in that 6-month period, how much of your balance was at risk. So if you had, say, 5 positions open and you closed all of those 5 positions at the same time, you would have lost, if it was your balance, 4.63% of your balance. That would have been gone. Okay, the fact that those positions didn't close or may not have closed, it still means that, and they might have closed with a profit, you're still 4.62% or 63% drawdown. So the drawdown is how much risk you had during that period. So it's very important to look at drawdown as much as it is to look at net profit, because it's your risk reward sort of scenario. Okay, so the max equity drawdown is how much of your equity, so all your positions open at the same time, so your balance plus winning positions that are open, how much of that they have a drawdown as well. Okay, so the idea is at the moment you can see if you run it for 6 months, it's just £195 net profit. Now if you buy this robot for £19.99p, I mean that's nothing if you're gaining £195, but for some people it's not a lot of money and they want to risk a little bit more, or they want higher returns. So I'm going to show you how to do that. Okay, so all you need to do is simply on the robot's parameters you increase the volume. Okay, I'll increase the volume there, put a 0 at the end. Now what I'm also going to do for this back test, I'm going to increase the starting capital to 5,000, because if you want to keep your drawdown low as well, you might need to change your starting capital so your drawdown stays low. Okay, so that means that your capital is bigger, so it means your drawdown will be lower. Okay, I'm going to run this now. I could have left that at 1,000 and run this again. You'd have a much higher drawdown. You still have a good return over 1,000. The actual net return will be higher. I'll show you both. Okay, so you can see with a £5,000 equity starting balance, sorry, it would have gained £1,964. That's 39% increase, but with a 8% max balance drawdown. Okay, I'm now going to change it back to 1,000. Okay, and what you're going to see now is a bigger profit, but also with a higher drawdown. So you could start with a £1,000 capital. You'll just risk more of that £1,000, but you'll get a higher return. Okay, so it's 196% return of your capital. So you started with 1,000, you would have ended up with 2,964. That's an increase of £1,964. Okay, but you're risking 24% of your equity and 19% of your balance. So if people don't mind that and they want bigger returns, you just have to take bigger risks. This is the industry, really. So the idea is to get a balance between realistic returns with low risk, but some people, like people that go and play poker or go to vending machines, they don't mind a bit of risk and gambling. They like the higher returns. So this gives you that opportunity to choose what you want to do. Okay, so I'm going to turn this now back to 5,000. Just one last example, and I'm going to increase this to 200,000, 200k, and 240k. Put another 0 there. Okay, I'm going to run this again. Okay, this is on 5,000, and just see what it comes back at. Okay, it's got an increase of 79% over your 5,000, so it's turned 5,000 into 8,928 with a £3,928 net profit. The max balance drawdown was 12%, which is not too bad. Max equity drawdown is 15%. So normally 5% is good. That's the target that most people do who want a low risk, but some people don't mind the higher drawdown. So when you do the back testing, look at the difference between the drawdown and the net profit. The lower risk, obviously the lower drawdown. If I was running this robot personally, I would do it on the lowest possible drawdown of 5%, get the lowest return, let it run for a long period of time if I'm happy with the results. Okay, because the historical results don't they're not necessarily the future results are going to be the same as this. So you cannot say in the next 12 months I'm going to gain 3,928. You might lose. You don't know. It's that's the way it is. But the probability is higher if you use a robot that can run on some fresh data, which would be good. Okay, that was just an example to show you for these trading robots how you can increase your profit. Okay, that's it.